I think you have to go back in time and look at history when you have past rate cutting cycles. And I think it's very interesting to look at the past rate cutting cycles that started with 50 basis points. So the last time that happened was in 2007. And oddly enough, September 18th, so 2007, which is the exact same September 18th that we had here in 2024, where they cut by 50 basis points. And most people think that when the Fed cuts rates, then the long end of the curve automatically goes down. And that would make intuitive sense, right? But what's really quite fascinating is when you look at these past rate cutting cycles, it's actually the opposite what plays out. So when we rewind to 2007, CPI was around 3.5%. And then if you fast forward to August of 2008, and by the way, the Fed started cutting rates from 5.25% in 2007, just like they started cutting from 5.25% in 2024. So another similarity.
George Gammon discusses historical patterns of rate-cutting cycles by the Federal Reserve, comparing past instances, like 2007 to 2008, with current trends in 2024. He highlights how these cycles often produce unexpected outcomes, such as rising inflation despite rate cuts. He predicts a potential global economic slowdown or recession in 2025, driven by factors like declining oil demand, financial stress in China, and synchronized rate cuts by global central banks. Gammon emphasizes that economic narratives often repeat, but warns that outcomes can differ. He also touches on the strength of the US dollar, global liquidity risks, and opportunities in assets like gold and oil during downturns.
And what happened is, let's say CPI in 2007 was around 3% when they started cutting. If you fast forward to August of 2008, the CPI was up to 5.6. So the CPI went up substantially while the Fed was cutting interest rates from, I think in August, it was right around 2%. So they cut from 5.25 all the way down to 2%, while the CPI headline was actually going up. And then if we get super focused on 2008, going into January, they were supposed to meet January 29th. And they actually had an emergency meeting in January 22, where they dropped by 75 basis points. And then a week later, when they were supposed to meet initially, they dropped by another 50. So they're dropping by 150 basis points in 1 week in January. While at the same time, the 10-year treasury from that point to August went up as far as the yield, right? So the reason I focus on that is because a lot of what happens in these rate cutting cycles is extremely counterintuitive. So a lot of the narrative right now is the Fed has dropped too quickly. The economy was booming. They should have cut by 50 basis points. They're going to have to pause because now, they're going to reaccelerate inflation, and we're going to have to worry about the long end of the curve, the interest rates going up, and the Fed has lost control. When actually, if you look at it, this happens every single cycle. And of course, once we get to August of 2008, when that 5.6 print came out on the CPI, if you look at the Wall Street journals that came out right after, the day after that CPI print from July 2008 in August, everyone was talking about how the Fed's got to start hiking rates. At the end of the year, they've unleashed inflation genie. They cut way too much into an economy that, yes, the stock market was going down. The economy is not doing that bad. Unemployment, relatively speaking, is low, and all these things, right? When if you fast forward 2 months from there, as you know, interest rates were at zero. And then if we fast forward a year, the CPI went from, call it 5.4, 5.6, all the way down to a -2. So that's not to say I'm predicting that for 2025, but that is to say that if you study history and you study these cycles, like we were saying earlier, a lot of what plays out is very, very counterintuitive. And the narratives that we're hearing in the market right now are the exact same narratives that you heard in cycles like 2007, 2008. I think it's very contrarian right now to say that interest rates will be lower at the end of, call it 2025, but that would probably be my base case. The yield curve has been predicting a slowdown for the last 2 years, and the yield curve is not foolproof, but it's right 95% of the time. So we have to give that a lot of respect, especially when you combine that with the Samuel, and then you combine that with some esoteric stuff like swap spreads being negative, and why that's another signal that especially global banks and the Eurodollar system are risk off, right? And then you look at the price of oil. I would give that as another example, as look at the demand side globally for oil. It's plummeting. It's sure the supply side's going up, which is pressuring that. and taking it under 70. But even with the supply side being what it is, the demand side is going down to an extreme to where you have two wars, one in the Middle East, for heaven's sakes. And plus you've got OPEC, those production cuts that they have, OPEC plus, they're at historic highs, right? Yeah. Those production cuts are higher than what we saw during the GFC. If you just had normal production cuts from OPEC plus and you didn't have two wars, take that out of the price of oil, and we're at $45 a barrel.
Yeah.
So what does that tell you about global demand? What does that tell you about the health of the global economy? Especially when you combine that with the U.S. inversion and now uninversion, which is usually when the stuff hits the fan. It's not when the curve's inverted. It's when the Fed starts cutting rates and steepens up. So you combine all these factors and you see that, again, no certainties, only probabilities. But my base case is that we have a slowdown, contraction, recession, whatever you want to call it, in 2025. And when you have a recession, it's always disinflationary. So now a lot of people freak out when I say that. They say, what are you talking about? Look at the 1970s when we had stagflation. Okay, fine. Well, let's just go back and look at the 1970s. When you had the recession in, call it 74 and 75, 1980, like all recessions, you had that big spike right in the middle of unemployment. So if you look at that spike in unemployment, and then when you start to get that official recession from the NBER, we always have disinflation, even in the 1970s. I'm not saying that we had deflation, but I'm saying that from that point, 75, call it, we had the rate of inflation going down when we had a recession. It never goes up. I'm not saying that the CPI headline right now at 2.6 is accurate. I totally agree with, everyone that it's really probably 5, 6, maybe even higher. And everyone has their own inflation rate depending on what you have to buy every single day. But that doesn't mean that just because we've had massive amounts of consumer price inflation that no one denies, that we will go into this recession and it'll somehow be different than every single other recession that we've ever had in U.S. history, even the 1970s, where the rate of inflation actually goes down. And to your first question, how much of a downturn will we see? Well, it depends on if we have a liquidity event. If we have a liquidity event where it just completely dries up like we saw during the GFC, is it possible that we actually had a quarter outright deflation like we had in 2009? Sure, definitely possible. There's no denying that if you had normal OPEC constraint on supply and you didn't have those wars, we would be like 45, 50. If you look at even $50 oil, and that's nominal, go back and look at charts adjusted for inflation of oil prices. Whenever they get below like 40, oil is very cheap. And it's usually cheap not as a result of the global economy booming. It's usually cheap for the opposite reason. And again, people will argue, well, we have supply increasing in the United States and it's drill, baby, drill. Yeah, I get all that. But you've got to not just look at the supply side of the equation and come to the conclusion that that explains the price being, let's just say at 70. No, a lot of that is forward-looking demand globally on the decline. And, we get hyper-focused on the United States for obvious reasons. Yeah, because we're all American. But you got to look at China. China right now is literally in a GFC. People don't understand that. People oh yeah, you're being hyperbolic. No, I'm not. Just look at what's happening there. The Chinese real estate market was the largest asset class in the world as of about 2 years ago.
I just said that.
Yes, $60 trillion. It's come down by 30%. So what that means is you've got about we'll call it $20 trillion of household wealth in China is gone. And 70% of household wealth was in real estate. So you think about what aggregate demand looks like for the average consumer, or aggregate demand looks like in China, and then look at that through the lens of the average consumer. They are in extreme amounts of financial pain right now. Very similar to what we would have experienced in 2009, 10, 11. And then you say, well, that's just China. Who cares? That's not the United States. Okay, well, what you have to do is you have to understand that we are in a very, very highly connected global economy. In fact, I would challenge any of your viewers to go back in time and try to find when we had a recession in the UK, in Europe, which they're pretty much in right now in Europe, especially Germany. But then, UK, who knows, are probably on the edge. You look at Japan, Canada, for heaven's sakes. Their unemployment rate is really skyrocketing. So you have all these global economies that are close to, if not in contraction. And then you have the United States as the outlier. And you say, okay, well, in history, how often has the United States or any one of those countries been a complete outlier when all of the others are in recession? It never really happens. And by the way, look at at other central banks. Look at the Bank of Canada. Look at the South Korean Central Bank, the Bank of New Zealand, all of these the ECB, they're all dropping rates. Look at the Swiss National Bank, the Swedish National Bank. They're all dropping rates a lot faster than they said they would as of 3 or 4 months ago. So it's just the Fed that's really where the narrative is all about maybe higher for longer. But it's like maybe the Fed could pause and all the other global central banks are cutting at the exact same time all the way back down to zero or whatever they cut to. But it's very unlikely, whether we like it or not, that the global economy sees the dollar as a safe haven asset, along with U.S. treasuries. So if you see the dollar ripping higher, that could be one of the reasons why. And also, too, what's interesting is you've got really 4 dynamics that are possible with the US dollar relative to other currencies, right? You got demand going up, supply going up, demand going up, supply going down. So when you look at those first two, I like to focus on those in terms of risk on, risk off, because usually what you have is when demand is going up and supply is going up, that's usually risk on. So my example that I would give you would be 2000 to like 2011, when with the exception of the GFC, when we had all the boom in the emerging markets and China and there was massive demand for dollars because everyone wanted to start that factory to build those widgets to sell them into the global economy because we had this massive expansion. And what they were doing, again, whether we like it or not, is to build that factory. They don't need Malaysian ringgits or whatever the hell. Even though it's in Malaysia, they have to borrow dollars to do that. So you see this risk on. You see a lot of the demand for dollars going up, the supply of dollars going up, because all these banks, they're like, screw it, we're not going to buy treasuries. No way. We would rather take that balance sheet capacity and lend it out into the real economy because we see all of these opportunities. So then what did the DXY do from 2000 to 2011 or whatever? Go straight down, right? Where then since 2011, 2012, it's pretty much, for the most part, gone straight up to the point where now, like you said, we're at 106 or 107. So you have to say, okay, now I think it's more risk off, where you have demand going for dollars up because not everyone is gung-ho on the global economy, but they have to have those dollars to pay off that debt that they've accumulated over the last, let's just say 2 decades, and they keep rolling over or whatever it is. But at the same time, the banks now, instead of being risk on, are risk off. So you have the demand for dollars going up, but the supply of dollars going down, DXY up. I have my highest conviction 2025 probably be gold, barring a liquidity event. If we have a liquidity event, gold's the correlation of everything goes to 1. So gold's going down. Just like we saw during the GFC, when gold, I think it was from, you probably know better than I would, from August to September, something, gold probably went down by 30%. It took a massive dive right there because it was the only thing on the balance sheet that people could sell to actually generate the cash that they need. Therefore, everyone sold gold, price drops. That's your buying opportunity. We could have a recession in 2025. It's just a balance sheet recession. Very similar to what we saw in 2001, where it's on this catastrophic event. It's just simply where asset that, the S&P goes down by 30%, maybe housing over the span of 3 or 4 years in real terms goes down by 30%. You get that balance sheet recession, unemployment spikes, you have a couple quarters of negative GDP. And in that scenario, I don't think gold really tanks because no one has to sell it in order to generate the liquidity. I would be a little concerned about going into a slowdown like oil and whatnot. But to be clear, I think longer term, that would be your buying opportunity. If I had to fast forward like 5 years or 10 years, I would probably put my money in probably uranium, almost as an AI play.
George Gammon emphasizes that while economic patterns and narratives tend to repeat, the outcomes can be counterintuitive and unpredictable. He highlights the importance of studying history to understand potential scenarios, such as the possibility of a global recession in 2025, marked by disinflation, financial stress, and shifting asset values. His analysis suggests staying prepared for economic uncertainty and viewing downturns as opportunities for strategic investments, especially in assets like gold and oil over the long term.